2.5 million ounces every single week. That is the current rate at which silver is leaving the vaults in London and New York, and when those figures are set against the remaining registered inventory data, the velocity of that departure demands serious analytical attention. This is not a gradual decline. It is not a routine seasonal adjustment in vault holdings. It is a sustained directional outflow operating at a pace that, when measured against historical withdrawal norms, represents a material departure from the patterns this market has exhibited across prior cycles. Today we will examine precisely where that silver is going, why it is moving at this velocity, and what the implications are for investors holding physical metal on either side of the Atlantic. Because the structural story behind that withdrawal rate is not the story that is currently receiving adequate coverage, and the dimension that tends to get compressed into a single alarming headline is precisely the dimension that carries the most analytical weight, 15 years in currency and commodity markets before transitioning. This work provides a particular vantage point. From inside those markets, it is possible to observe directly how institutions manage exposure when physical signals begin to diverge from paper pricing, and what the operational fingerprints of large-scale physical accumulation look like when they begin to appear in publicly available data. That experience is the basis of the framework applied here. Everything presented in this analysis is sourced from named, publicly available sources: the CME Warehouse Report, LBMA published vault data, Shanghai Futures Exchange benchmark figures, and CFTC positioning data. All sources are identified explicitly as we proceed. In the previous analysis, one specific metric was identified for monitoring whether COMEX registered silver inventory would breach the 100 million ounce level within 5 trading sessions, and whether the spot premium over futures would hold above $1.5 during that period. The outcome of that call will be stated precisely and without revision, because accountability to a specific time-bound prediction is the only standard that distinguishes analytical rigor from retrospective narrative construction. Whatever the data showed, it is called exactly as it landed. Now the story this week is structurally larger than last week's setup, because what the vault withdrawal data is revealing extends well beyond a single week's inventory movement. This is a pattern that has been developing across multiple months, and understanding it requires examining the full picture of where these flows originate, where they are likely terminating, and what the mechanics of that movement tell us about the balance of supply and demand in the physical silver market. Here is the current market picture. Western spot silver, the price at which immediate physical delivery would be transacted in London or New York, is currently quoted at $72.73. That is the figure most US and UK investors are tracking. The figure receiving considerably less attention is the Shanghai silver benchmark, which, converted to US dollars at the current exchange rate, is pricing silver at $79.8. That produces a spread of $7.07, a 9.72% premium for silver in Shanghai relative to the Western price. This differential is not attributable to a data anomaly. It is not a currency distortion. The DXY, the dollar index, is holding at 100.46, a reading that places the dollar in a broadly neutral range rather than a position of material weakness. A dollar at this level does not generate a commodity price differential of this magnitude through currency movement alone. What is observable here is a genuine and sustained price divergence between two of the world's largest silver markets. And price differentials of this scale, when they persist across multiple weeks rather than closing through rapid arbitrage, communicate something specific about the structural condition of the physical market. They communicate that supply cannot move from the low-price market to the high-price market quickly enough to close the gap. Metal flows from where it is priced cheaply to where it commands a premium. Currently, the cheap market is London and New York. The premium market is Shanghai. And the 2.5 million ounce weekly withdrawal rate from Western vaults is the physical expression of that arbitrage operating in real time. Understanding the mechanics of what is occurring inside these vault systems requires distinguishing between the two inventory categories that the COMEX reporting framework uses. Eligible inventory represents silver stored in approved vaults that has not been formally cleared for delivery against futures contracts. Registered inventory represents silver that has been specifically designated as deliverable, a status that carries administrative requirements and associated costs to establish. What the most recent CME warehouse data reveals is not simply a broad decline in total silver holdings, it reveals a specific and operationally meaningful sequence. Eligible inventory is being converted into registered status and then withdrawn. This is the institutional fingerprint that distinguishes deliberate physical accumulation from routine inventory management. An institution that converts eligible silver to registered status incurs the costs and administrative steps associated with that designation, and then, rather than using that registered status to fulfill a futures delivery or facilitate a paper transaction, uses it as a mechanism to extract the physical metal from the Western vault system entirely. The implication is unambiguous. These institutions are not positioning to execute a paper trade. They are using the delivery architecture of the futures market as an exit door. They want the physical metal removed from the Western system, the destination suggested by the Shanghai premium. the urgency suggested by the withdrawal velocity, and the dollar context provided by the DXY reading together form a coherent picture. This is an arbitrage trade running at institutional scale across the London-Shanghai silver corridor, and it is being executed with a consistency and velocity that suggests it is driven by structural demand rather than opportunistic positioning. The analogy that makes these mechanics most visible is straightforward. Consider two fuel stations positioned at opposite ends of the same motorway. One charges the equivalent of $72.73 per unit. The other, at the far end, charges $79.8 for identical fuel. A commercial tanker operator in that environment has a clear and repeatable trade: purchase at the cheap station, transport to the expensive station, and capture the spread. That trade continues until one of two conditions is met: either the cheap station exhausts its supply, or the price gap closes because sufficient volume has moved to bring the eastern price down or push the western price up. That is precisely the arbitrage structure currently operating across the western to Shanghai silver corridor. The LBMA vaults in London and the COMEX vaults in New York are the low-price station. The Shanghai Futures Exchange is the high-price station. 2.5 million ounces per week is the tanker traffic. Intellectual honesty requires acknowledging what this flow data does not confirm with certainty. Real-time visibility into the precise destinations of every ounce leaving Western vaults is not available in the public data. Some portion of the 2.5 million weekly withdrawal may be moving to private storage, to industrial users taking direct delivery outside the tracked vault system, or to allocated accounts that remove metal from public reporting without it being confirmed as crossing into China. The Shanghai premium is the most visible and analytically compelling primary driver of this flow, but the data confirms the departure with certainty rather than the destination with certainty. That distinction is worth maintaining clearly. Industrial demand constitutes the structural foundation beneath this entire narrative, and it is the dimension that receives the least adequate treatment in most silver market commentary. Understanding it properly is not optional context. It is essential to correctly interpreting why the Shanghai premium exists at this level, why it has not been arbitraged away as quickly as a purely financial premium would be, and why the withdrawal velocity from Western vaults carries the structural significance that it does. The Silver Institute, which produces the most comprehensive annual demand analysis in this sector, has documented multiple consecutive years of structural supply deficits in the silver market. These deficits reflect a condition in which global industrial consumption is outpacing mine production on a sustained basis. This is not a transient imbalance attributable to a single year of production disruption or demand spike. It is a multi-year structural condition, and its persistence has direct implications for the thinness of the inventory buffers available to absorb demand shocks. Solar energy manufacturing stands as the most consequential single driver of incremental silver demand in the current decade. Each photovoltaic panel incorporates silver within its conductive architecture, specifically in the silver paste applied to silicon cells, which facilitates the electron collection and transfer necessary for commercial efficiency levels. The global deployment of solar generation capacity has expanded at a pace that was materially underestimated by most commodity forecasting models as recently as 5 years ago. This is not an experimental application operating at pilot scale. It is an industrial deployment measured in hundreds of gigawatts of new capacity annually, expanding simultaneously across North America, Europe, and Asia. The defining characteristic of industrial silver demand, the characteristic that distinguishes it most fundamentally from investment demand and that makes it so consequential to a supply analysis, is its relative price inelasticity. When silver prices rise, investment buyers can defer, reduce allocations, or substitute into alternative assets. Industrial buyers do not have that option in most current applications. For a solar panel manufacturer, a semiconductor producer, or a medical device company operating at scale, silver is not a discretionary input. It is a process-critical material for which no commercially viable substitute currently exists across the majority of its applications. The economic calculus for an industrial buyer facing elevated silver prices is not whether to purchase silver, it is how to absorb the cost increase within the broader production economics. The production line does not stop because the silver price is elevated. The cost is absorbed because the alternative is halting output. This price inelasticity means that industrial demand functions as a structural floor beneath the silver market that does not respond to price signals in the way that financial demand does. It does not compress when prices rise. It does not defer when sentiment deteriorates. It is present, consistent, and growing. The electronics sector constitutes a second major industrial consumption base that aggregates to significant scale when considered across global production volumes. Silver appears in virtually every category of modern electronic device in contacts, connectors, switches, and the conductive pathways of printed circuit boards. Consumer electronics, automotive control systems, telecommunications infrastructure, industrial automation equipment, and medical monitoring devices each consume silver in individually small quantities that collectively represent a substantial and growing industrial draw. As electronics penetration deepens across both developed markets and the expanding middle-class populations of emerging economies, this demand base expands with it. Medical applications represent a third demand category that receives insufficient attention in most commodity analyses. Silver's well-documented antimicrobial properties have driven adoption across wound care products, surgical instruments, antimicrobial surface coatings, and implantable medical devices. As global healthcare infrastructure expands, particularly across emerging market economies that are actively building out hospital and clinical capacity, this demand base is positioned for sustained growth. The electric vehicle transition introduces a further demand vector of increasing materiality. Silver is present in EV charging infrastructure components, in the battery management electronics that govern cell performance and safety, in power inverters, and in the broader suite of power management components within the vehicle architecture. As the global vehicle fleet continues its transition from internal combustion to electric powertrains, the silver intensity of automotive electronics increases substantially relative to historical baselines, a further characteristic of industrial silver consumption that is rarely addressed in commodity commentary but is structurally significant is the dispersion and effective loss rate inherent to its end-use applications. Silver consumed in photovoltaics, electronics, and medical devices is not stored in recoverable, concentrated form. It is distributed across billions of individual units in quantities measured in fractions of a gram. The economics of recovering silver from dispersed end-of-life consumer products are frequently unfavorable relative to primary mining costs, which means a meaningful and growing proportion of industrially consumed silver is permanently removed from the available supply base. This distinguishes silver sharply from commodities with well-established secondary supply infrastructure. The combined effect of price inelasticity, sectoral diversification across multiple major consuming industries, and structurally low recovery rates is to establish industrial consumption as a durable and expanding floor beneath the silver market. It does not fluctuate with speculative sentiment. It does not compress in response to price increases. It is precisely this structural characteristic that makes the Shanghai premium analytically distinct from a purely financial premium. Chinese industrial demand for silver spanning solar manufacturing, electronics production, and electric vehicle components is not discretionary, and it is not price sensitive in the short term in the way that financial demand is. When you layer institutional accumulation at the sovereign and government level onto that inelastic industrial base, you produce a market that is willing and able to sustain a material premium because the cost of running short of a critical industrial input is not acceptable. The premium is the price of supply security for buyers who cannot afford supply interruption. That structural demand characteristic is what powers the tanker traffic out of Western vaults. The LBMA, the London Bullion Market Association, functions as the world's largest over-the-counter precious metals market and the primary global benchmark for silver pricing. When LBMA vault data exhibits material drawdowns alongside a sustained east-west premium of the magnitude currently observable, it attracts attention from market participants who track the relationship between London vault levels and futures pricing closely. For UK investors holding silver through a SIPP or allocated storage account, the LBMA vault situation is not an abstract institutional matter. It is the operational foundation of the pricing architecture against which those holdings are benchmarked. World Gold Council data on institutional precious metals flows has continued to reflect accumulation patterns inconsistent with short-term trading behavior, and the Silver Institute's multi-year deficit documentation provides the structural backdrop against which this vault drain is occurring. These are not independent signals. They are components of a coherent structural picture. The three lanes framework applied here separates the signal from the noise across three distinct market dimensions. The paper lane COMEX open interest elevated against registered inventory. CFTC caught data showing managed money navigating a market where the physical signal is outpacing the paper signal, and a futures price sitting $7.07 below where the same metal is trading in Asia is communicating that the paper market has not yet fully adjusted to the physical reality. The physical lane 2.5 million ounces per week leaving LBMA and COMEX vaults, eligible to registered conversions followed by immediate withdrawal, and a $7.07 Shanghai premium unexplained by currency movement is the loudest signal in the market and is communicating that supply is moving east faster than it is being replenished in the west. The macro lane a neutral DXY at 100.46 that removes the currency explanation and forces attention to the physical fundamentals, combined with ongoing fiscal trajectory concerns, central bank accumulation data, and the Silver Institute's structural deficit documentation is providing no counter-argument to either the paper or physical signal. The asymmetry is significant. The physical lane is clearly leading, the paper lane is lagging, and the macro lane is aligned rather than contradictory. Both forward scenarios must be presented with equal rigor. In the constructive scenario, if the $7.07 Shanghai premium holds or widens while Western vault withdrawals continue, At current velocity, the Western paper market faces increasing pressure to close the gap from below, meaning Western prices rise toward the Shanghai level. Physical holders in the US and UK would be positioned in metal priced at a discount to where the same metal is transacting in the world's most active physical market, and a catch-up adjustment would be felt most directly by those holding the physical metal rather than paper positions. In the cautious scenario, a sudden global liquidity event, a credit shock, a forced deleveraging across commodity markets, or a broad risk-off episode compresses the Shanghai premium rapidly as institutional participants reduce exposure. The East-West arbitrage closes not through Western price appreciation but through Asian demand contraction. Withdrawal velocity drops, the premium collapses. Anyone positioned aggressively into Western silver expecting a rapid catch-up trade bears the full force of that reversal. Both outcomes are genuinely possible. The metric to monitor this week is the weekly withdrawal velocity from CME and LBMA vaults. If weekly withdrawals exceed 3 million ounces while the Shanghai premium remains above $6, that acceleration indicates the arbitrage is intensifying rather than self-correcting and that the flow is outpacing replenishment from mining supply or recycling entering the Western system. If withdrawal velocity decelerates toward 1.5 million ounces or below even while the premium persists, that suggests the arbitrage is becoming less accessible, possibly because the most liquid eligible inventory has already been mobilized and the remaining pool is harder to move quickly. The CME Daily Warehouse Report provides that figure every trading session. All content presented here is for educational and informational purposes only, based exclusively on publicly available data. Nothing contained herein constitutes financial advice, investment advice, tax advice, or legal advice of any kind, and nothing should be construed as a recommendation to purchase, sell, or hold any financial instrument or asset class. All investment decisions should be made in consultation with a qualified financial professional.